Good morning. This is Eric Brotman from BFG Financial Advisors, and I'm here with Nicole Hewitt. And we're going to be talking about Maryland's tax landscape. We're going to talk about a little bit from a federal standpoint, but mostly concentrate on Maryland. So, Nicole, would you like to introduce yourself first?
Absolutely. Good morning. I'm Nicole Hewitt with HWK Law Group. My areas of expertise are estate planning, elder planning, and really with a tax focus on all of these things.
And for those of you who don't know me, I'm the CEO of BFG Financial Advisors here in Lutherville, Maryland. I've been practicing 32 years and running a wonderful team here. And we do financial planning, wealth management, and work with folks across the financial spectrum from private wealth management to entry level financial planning. So excited to dive in. We have Hannah Dennis behind the scenes today. She's going to be collecting questions. So if you have questions, you can use the chat box on the right of your screen. If it's relevant to a slide we're on, she'll interrupt us. She loves to do that. If not, we'll wait until the end, and there'll be plenty of time for Q&A as well. So Hannah, if we can advance the slide, we're good to go. Let's dive in. Right now, we are in the process of tax season. That's why we don't have a CPA with us today. It seemed cruel to ask a CPA to take an hour out of his or her day in late March when they are living at their offices. But Nicole, do you want to talk a little bit about some of the changes that are coming down the pike specific to Maryland in the income and sales tax areas?
hmm Yeah, so I'll start because the sales tax area tends to be, the kind of the hot topic right now legislatively. Um, and that is really a proposal in Maryland legislature right now to tax certain services. So that is a huge area because right now there are many services that are not being taxed. So ultimately, when any sort of sales tax comes through and is taxed to a business, the business has to pay this tax, but, there is that trickle down effect because ultimately, the consumer does pay those taxes because, the price of services goes up and it gets passed down. So that's really the big sales tax area that's coming into play with services. I guess a lot of this depends on lobbyists, and fortunately, at least for the legal industry, that is an exempt service that would not be taxed at least at this point. But many other services, such as accounting, there's different areas where there are going to be taxes if this gets passed. And then from the income tax landscape, it's just the raising of income tax rates is number one area, but the other really big area is the exemptions. So when you file a tax return, you either can elect to itemize your taxes or itemize your deductions, or you could take a standard deduction. What they are proposing is eliminating the itemized deductions, which would definitely affect people with slightly higher wages who do deduct. But what they're planning on proposing is doubling the standard deduction. So everybody would have a level playing field in terms of those deductions. What really the impact of this is it trickles down really to the county level, because as we do this, when you have county taxes, those county taxes kind of get deducted off the state taxes. There's a netting that occurs, so there's not double taxation. The chilling effect here is counties will have less revenue. So a lot of the counties are really upset about this doubling of the standard deduction and the lack of itemization, because that means there will be less funds collected from the county level, and then the counties will be running a deficit. So those are the really two hot issues. And Eric,
Yeah.
if there's other ones that I kind of missed there that you want to touch
Well,
on, I'll let you jump in.
I'll add to that a little bit. The county tax, what I think we're going to see as the ripple effect of that is that the counties are going to raise their real estate taxes.
Mhm.
That is one of the largest sources of revenue for counties and municipalities. So, and I know we're going to talk about that in a minute. From an income tax standpoint, Maryland is running a massive deficit currently, and the deficit, unfortunately, is likely to exacerbate over the coming years, partly due to the fact that a lot of federal employees are having their jobs taken away, or there's downsizing in Washington D.C., which impacts Maryland very, very significantly. And so if there are fewer people working, there are fewer income taxes collected from fewer people. That creates a problem at the state level, not to mention what it does to individual families. The sales tax on services, I believe the Maryland Chamber of Commerce was leading a consortium of business groups to try and fight that, and I was a part of that. And ultimately, I think the only one that is likely to pass is on IT. So IT services are likely to be subject to a new 2.5% sales tax. I don't know for sure that it's going to be final that way, but it's likely. The conversation about how sales taxes were going to hit services, it's not only, you mentioned, Nicole, that it would impact businesses because we'd have to pay it. It's not just that it impacts the business and therefore the consumer, it also could create some job loss at the business level, depending on the size. It will certainly make services more expensive. And I had written to our Annapolis delegates, and I heard back from one of them who said, well, our economy used to be a product economy, now it's a service economy, and we have to do this to keep up with the changing world. And so I think they are, for lack of a better term, hell-bent on doing this. It's just a matter of when and how, and how significant. And it does create an interesting dichotomy, because now if you have a Maryland office and you're working with Maryland clients, you would charge that sales tax, but for non-Maryland clients, you would not charge that sales tax, which creates a reporting issue for businesses as well. And so it remains to be seen how this plays out. I know that the income taxes now in Maryland are as high as 9% and on the rise. And so if we're careening toward becoming the California of the East Coast, I don't know that that's particularly good for anybody here. So let's move on to the next, Hannah, if we can, and talk about real estate, because, and I'll take this one first if you're all right with that, Nicole, and we'll just
Absolutely.
alternate. The real estate taxes, as I mentioned a few moments ago, are really a huge source of revenue for counties, cities, municipalities, and so forth, because that is where all of their residents pay for the property that they own. And what we're seeing right now is not necessarily a higher tax rate, but we're seeing new assessments. Housing prices have gone up pretty significantly, and the assessments in some cases are doubling. So even if you don't feel like the value of your home has doubled, the value of your tax assessment might. And so keep an eye on that. When you get your tax assessments for 2025, there may very well be a significant jump in the real estate taxes due across the state. And that to me is significantly alarming for folks, particularly folks who are retired or on fixed income and are even mortgage free, who are having trouble potentially paying their own real estate taxes to stay in the home that they own tax free, or I should say mortgage free. There are a few states in the country that are right now trying to eliminate real estate taxes and swap them out. Of course, there's no free lunch, Nicole, you know that. So if one tax goes away, another will replace it. It's a matter of how and when. What can you share about the real estate tax landscape, both for residential and maybe also for commercial business owners or property owners?
Yeah, I mean, I think to piggyback on what you were saying, Eric, with the values of property increasing just because inventory is low right now in the state, and just with the climate of interest rates, which, ironically people think are very high, but on the whole scheme of things, they are, compared to the way they were in the 90s, they're very reasonable.
Yep.
But this is why it's really important that if you are in a house and you've been there for a while, that ensuring that you have registered with the state, that it is your primary residence, that you are subject to that homestead, which basically means that even though the values of houses, say in your neighborhood, might be going up and doubling, that you have locked in your property as being a homestead property, because the annual increase in what they can assess is capped. County by county, there's different caps, but generally it's around 4% or so that they can't increase the tax base for what they're taxing you on. So really important to go on, and about this time of year is when everybody gets their assessment letters saying, okay, here's your new assessed value of your property. It's going to affirm whether you have elected for your home to be your homestead. And if you notice that it's not, make sure that you are making that election. And if you don't also agree with the assessment, you can appeal that assessment. So make sure you get your appeal in on time. So if you kind of have that outlier house in your neighborhood that sold for significantly more, and that's really not indicative of what your house value is, because that is how they assess based on sales. Arm's length sales is what they presume that your house value is based on what your neighbor's sales are. So if you feel like that's not appropriate, make sure that you're truly appealing that, because they can come in and lower that assessment, which just means the phase in over time of your tax base, is a little bit slower.
So two good points. How do we do that? What is the process in terms of getting that done for people who maybe aren't familiar with it?
Sure. So when you get that paper with your new assessment, there is actually instructions on how to appeal it. That's one of those things where you can go it alone, or you can hire, there are real estate lawyers that can help you with appeal and assessment and making that process a whole lot easier. But
Okay.
it's doable.
Well, now, of course, that's difficult to do if the property has changed hands. So if you've
So
moved,
that's a really interesting point. So is the moment a property changes hands. So, if you buy a house, say in December, and you've bought it from somebody who's been there for 20 years, and that house is, say, assessed at $300,000, and you have now bought it for $500,000, they're going to come in and they're going to reassess it at what you purchased it for, because that is fair market value. So that's one thing that, buyers of homes should be aware of, because, you go to closing and taxes are collected probably based on what it was being assessed for prior. And then lo and behold, you get this larger tax bill, and if you have a mortgage, they're going to, adjust your escrows, and that payment's going to go up. So that's really something people need to be aware of when they purchase a new home.
good stuff. I don't have anything further to add on this. I want to shift though to businesses, because for business owners in Maryland, this is now a very significant time. Hannah, if we can flip the slide. Nicole, why don't you get started on this? And we definitely want to talk about Connolly. That's there on purpose, because this is now a federal issue that's going to potentially be a big deal for a lot of small business owners, especially. But let's talk generally first about the tax landscape for business owners in Maryland, because it feels like we're in the crosshairs all the time in Annapolis.
Yeah. So really, the business climate here in Maryland's a little bit challenging. For look-through businesses. So if you are a limited liability company, or an S corp, or somebody where there's pass-through income treatment, all that's flowing through to the individual owners. There are kind of what I like to call these like hidden taxes when you own a business in Maryland. If you have a LLC or an S corp, you have your annual reporting that you have to file every year. Due April 15th, you have to file your personal property tax return. It's $300. You can extend it for 2 months through June 15th, but that is due to keep your business in good standing. It's a filing fee, but I like to call it a tax, because that's really what it is, because no matter what type of business you have to pay, that amount. But, just business in Maryland is very interesting. There's not a lot of new businesses coming into the state. As you pointed out, Eric, Maryland is heavily turning to a service business type of state. There's not a lot of new industry in the state in terms of manufacturing or things like that. It's just not, the climate of our state right now. So anything else you want to add in terms of the business piece before we jump into Connolly?
Sure, yeah, a couple things. One, I don't think people who aren't business owners realize that not only do you have that filing fee / tax, but that it is giving permission to be taxed on the furniture you own and the other possessions you have in your office. That we pay taxes on our desks every year. Like, that kind of thing is so mind-numbing to me when you start to add that up and think about it. It's like, how is that a thing? Maybe we should just go back to milk crates. To heck with furniture. It feels like an option. The business climate here, and it's a little different than the business tax landscape, but it does matter. There are not a lot of incentives to draw major employers here. There are not a lot of incentives to draw, even, we talked about the income tax piece, but even to draw high wage earners and high net worth families here. I think we're seeing an exodus of those folks. In fact, I know we are seeing an exodus of those folks, more than anecdotally, because just doing what we do for a living, our clients are moving, and a lot of them because they can get a significant savings elsewhere. Now, again, there's no such thing as a free lunch. We know that all states, even the states without an income tax, they're raising revenue somehow. Revenue is the way the government likes to call taxes because it sounds better, but they're definitely doing it. From a business front, some of the regulatory climate here is really one of the issues. And I know that's beyond the scope of our discussion today, but it is something to look at. The barriers to entry for business owners here are still pretty significant. And that's why, the Chamber of Commerce and other business associations are so active. Let's talk about Connolly, because I'm anxious to hear your take on this, because I know this will impact BFG specifically and me personally, as well as many of the folks we represent. So I'll let you put your lawyer hat on for that one, and then I'll opine from sort of an insurance standpoint, because that's really what it's about.
So Connolly was a very interesting case, and I'm actually surprised by the outcome, to be honest. It just doesn't make sense to me, but that's how the tax court ruled. So basically, Connolly says that if we have two owners, I'm just going to use the example, it could be more owners, but if we have two owners, and oftentimes when we are looking at succession planning with businesses, there is an insurance policy that gets purchased to make sure there's liquidity to buy the partner or co-owner who passes away out. So in Connolly, it was a situation where one partner died. The insurance was paid to the company and not to an individual. So the company was the beneficiary. So when somebody passes, we have to value the entity. So say the entity, I'm just going to pull some numbers. This wasn't exact Connolly, but say the value of the company is $100,000. And then there was a $100,000 insurance policy on the person who died. When that additional $100,000 insurance paid out to the company, the court held that instead of the value of the company being $100,000, they took and added the insurance policy to the value of the company and said, okay, the company is now worth $200,000 just because it had that influx of the extra $100,000 for the life insurance. We know that that's not the true value of the company. That was a one-time hit. But they said, no, that's the value of the company. So because of that, instead of, if the value of the company was 100,000, 50,000 being included in the decedent's estate, we're now saying 100,000 is included in the decedent's estate. And that's really the buyout value. So really now we don't have enough life insurance to really do the full payout. It just messes things up. And it could, when the numbers are large enough, that additional life insurance may send the estate into, an estate taxable arena where it may not have been before. So because of this case, it really changes the way that business owners have to buy that kind of key man life insurance policy, where individuals need to own the policy and individuals need to be the beneficiaries. So what it means is, in the Connolly case, if, say, the money was actually, the life insurance money was actually paid, say, to the spouse of the decedent, the spouse or the individual other owner, then that other owner could have then paid out the person whose family who passed away, and that money would not have been included in the value of the business. So the ultimate, not to get too complicated, the ultimate rule here is that you should never have life insurance paid out to a business, because that is going to increase the value of the business. So really throws a wrinkle into planning, a wrinkle into how life insurance might be purchased. There's a whole, I'll let Eric, talk about this. There's a whole way to buy in life insurance, and there's, whether it's deductible to a business or not deductible to a business for the premiums paid. But it just really, puts a new focus on any business that has life insurance should be reevaluating ownership, who owns it, and who the payee is, because it really can have dire consequences.
So I think you encapsulated that perfectly. What businesses do, they form and they fund buy-sell agreements. So that, for example, if I were to pass away, the company would have enough money to buy my shares from my widow. And that's been happening for as long as businesses and life insurance have existed. That's been a strategy, and it's called entity purchase, where the company actually buys it and buys out the widow or the family or what have you. And it's the reason to do entity purchase for many years was because you needed fewer policies. There was a lot less administration. If you and I were business partners, Nicole, we could have our company buy a policy on each of us, or we could buy a policy on each other. That doesn't create complexity, piece of cake.
Right.
But if we had 5 partners, it would mean that each of us would have to buy a policy on each of the other 4 partners. Suddenly you have 20 life insurance policies instead of 5. And that kind of complexity, which now is being suggested by this case, also means that we have to figure out how to transfer existing policies. Can you transfer an existing policy owned by a company to someone without it being an exception for transfer for value? And there's some significant tax issues there. And you can't split it in all the ways that you need to split it. So that means business owners are now faced with possibly applying for new life insurance, paying a premium at an older age and at potentially a less healthy state. And all of this is bad. I mean, 100%. And I agree with you. The Connolly case felt like some weird circumstances that they didn't need to paint with a broad brush. And all of the insurance executives that we've talked to have said that they expect that this will get overturned by the end of 2025 and to sit tight. That's a scary thing. If you're sitting tight and there's a tragedy this year, you could wind up with a real serious problem. And we're going to shift and talk about estate taxes, because one of the biggest issues facing Maryland taxpayers. I mean, this is an expensive place to live, an expensive place to work, an expensive place to go to school. It's a wildly expensive place to die. I mean, Maryland is the only state in the United States that has both an estate and an inheritance tax. We win the award for the most taxes applied when someone dies. It used to be us in New Jersey, and even they saw the light. So that's a wrong way to say it when we're talking about somebody dying. But nonetheless, let's talk about the estate taxes. There are federal limits and there are state limits to what you can leave. And to be clear, for folks who maybe don't understand how this works, the estate tax is applied on any assets that are owned by the decedent, either directly or through certain types of entities at the point in time where he or she died. And there's plenty of planning that can happen, and you're a pro at this and do lots of this. So why don't we talk first about the way the tax is calculated, and then we'll talk about ways to potentially mitigate it.
Sure. So I'll just touch with federal taxes to start with. So basically, you can give away between life and death. So the federal estate tax is actually a combination death tax, gift tax. So it's the aggregate of what you've given away during your lifetime and what you still own in your name at your death that you give away. And currently in year 2025, it's approximately 14 million per person, little shy of that. So basically anything that you give away during life and death, as long as it's under 14 million per person or coupled, combine that for a married couple, you're never going to have a federal estate tax. So that really does apply to the vast majority of people. Are not going to be, except for the wealthiest people, are not going to be subject to that tax. Maryland's a little bit different. So Maryland's estate tax is purely a death tax. Maryland does not have a gift tax. So you can give away as much as you want to anybody during your lifetime, never have to report it to the state, and never have to pay a tax on it. However, Maryland's estate tax is currently $5 million per person. And let me back up, because I did miss a really key point on the federal taxes. The federal, that's approximately 14 million this year, is set to what we call sunset and go back to what the rate was several years ago, and index back to $5 million, index for inflation, which they're saying is going to be about $6.5 million. That's assuming that in this year, our federal legislature does nothing to make that 14 million permanent. So that's still something that, with our current administration, I would not be surprised if it stays around that and not sunset back to the 5 million index for inflation. But again, that remains to be seen this year. So jumping to Maryland again, we're fixed at $5 million for Maryland. It's a pure death tax. However, there is current legislation in our Maryland legislature that is going to, or is being proposed to make that $2 million. 5 million, okay, that's, the average person may accumulate over their lifetime close to 5, but 2 million is a whole different ballgame. There are a lot of people when you factor in homes that are paid for, your retirement money, because retirement money is not exempt from the estate tax in Maryland. And just general savings, really easy for an individual to get to $2 million. So anything over 2 million, if this law passes or this proposed law passes, would be subject to the Maryland estate tax. So that's huge if that passes. In addition,
we should also, can I jump in real fast and
absolutely,
say,
please jump in on that estate tax.
one of the things that's also included is the death benefit. If you own a policy on your own life for the benefit of your spouse or children or grandchildren, the value of the death benefit is also includable in your estate. So if you have a home that's worth $400,000 and a retirement plan that's worth $500,000 and $1 million life insurance policy, you're already at 1.9 million. So to get to 2 million it is not a rare thing. It's a very significant thing, especially in Maryland, which Maryland likes to boast that we're the wealthiest state in America. We're not. We're the highest income state in America. We're not the wealthiest, but we're the highest income state, which means if you have large incomes and you've done a good job with some of it, you're going to be potentially in a better position to be wealthy, which means $2 million is going to cast a very wide net.
Yes, absolutely. So then you take that Maryland estate tax and you couple it with Maryland having an inheritance tax. So this inheritance tax that Maryland has there's no exemption in terms of dollar amount from this tax. There are exempt classes of people. So if you leave assets to a spouse, a parent, a brother or sister, or your children or grandchildren, great-grandchildren, they are exempt from the Maryland estate tax. The Maryland estate tax is a 10% tax on every dollar you leave to someone who is not part of those exempt classes.
You're talking about the inheritance tax. The
inheritance tax.
Yes.
So, and charities, and charities too do not get hit with the inheritance tax. But the biggest area I see people getting hit with, and I almost feel like it's a tax on people who don't have children, which is really horrible. So a lot of people, if you don't have your own children, you might leave to a niece and nephew. Nieces and nephews are subject to the 10% tax, or you want to leave something to a friend, you are subject to the 10% tax without exemption. So if you leave $10,000 to that person, the 10% of that is going to go to the state of Maryland. And it's a real tax, and it really does hit people in a real way, especially people who don't have children, is where I, in my practice, really find the biggest impact. So that is something that a lot of people don't know about. When I meet with clients and talk with them, sometimes they rethink about who they're going to leave to. They might want to bypass a brother and sister who are a little bit older and leave to a niece or nephew. And after we have this conversation, they change, and a lot of times we'll leave to that brother and sister to protect that 10% because that's a really big number.
So we've talked about income tax, real estate tax.
Nicole, I have a quick question regarding the Maryland inheritance tax. How does
Voices are heard in the background.
How does that apply to out-of-state heirs?
So really good question. It's all about where the person who is giving the money away died. So if you have a Maryland decedent and the estate's being administered here in Maryland, it doesn't matter where the person receiving the money lives. It's all about where the person has died. So, so you might have the niece or nephew that lives in, Michigan. The 10% comes off before they get their money.
Thanks, Anna, and thanks, Nicole.
Yep.
So just I want to sort of recap what we've discussed, and then I want to shift gears and talk about things we can do to plan, because we've talked about, I don't want to say doom and gloom, but we've talked about the ways in which we sometimes feel like punching bags, whether we're at our house, we're in our paycheck, we're in our business, or we're in our coffin, quite candidly. Let's talk about some things we can do, and I'll throw out a couple things, and I know you've got plenty of strategies as well, to shift some of the tax burden, both now and in the future for ourselves and potentially for our heirs. Because, we look at federal income tax rates. Let's start with income tax. The federal income tax rates right now are at modern day lows. They're actually, despite the fact that all of us are paying the piper now and some of us are angry about it, they're actually quite low as a percentage. And we have lots of people putting enormous amounts of money away and taking tax deductions for contributions, whether it's IRAs or 401ks or 403bs or other types of qualified retirement plans. And they're postponing taxation until later in life, post 59 and a half, retirement, so forth. The challenge is that, I think a lot of this planning was based on the fact that you'd be in a lower tax bracket when you retire than you are today. And for at least the people we represent, we're not seeing that as true. We're seeing folks who are in the similar income standpoint because they've done a nice job saving for themselves, they've invested for themselves. Their income's not going to be significantly lower in retirement than it is while they're working, but the income tax rates might be dramatically higher because, as you know, we have an enormous deficit and an enormous liability as a federal government. So some of the things people are doing to create tax certainty, one of them is using Roth IRAs or Roth 401ks, putting money aside that won't be taxed again during your lifetime from an income standpoint. That can be significant. Some of it is timing. It used to be people would put their IRAs off and take it last because they didn't want to pay taxes. But if you retire at, say you retire at 60, you don't have required distributions, or you won't until you're 75 years old. You might not be collecting Social Security until you're 70. If you do it right, you could have from 60 to 70 to utilize your IRA when you might actually be in a lower tax bracket than when you layer on some of these other things that are coming. So having a tax plan, determining when you're going to use different kinds of assets, has become more important. I'll throw one more thing in and then I'll let you opine on this. Leaving IRAs and 401ks to kids is no longer favorable. If you leave it to a spouse, you're fine. If you leave it to children, because of Secure Act 2.0, it used to be that the kids could stretch that out over their lifetime and take distributions based on their own age. So if you're 80 and you leave your 50-year-old daughter $1 million in an IRA, your daughter would take 35, 40 years to withdraw that money and pay taxes on it as the heir. Now it's capped at 10 years, which means if you leave that $1 million, your daughter who received it has to pay taxes, income tax on that $1 million within 10 years. Whether it's in 1 year or whether it's over a period of time, you can decide, but it's a thud. So we're seeing more and more people utilize IRAs either for charitable giving, because charities don't pay that. And between federal and state, I don't know about you, but I'm losing 40 cents on the dollar to federal and state tax. If you can avoid that 40% by leaving it to a charity, I frankly would rather give my favorite cause $1 than give the government 40 cents in most cases. But nonetheless, you can use some strategies there, and you can use life insurance to replace that wealth without the income tax burden, so long as you don't increase your estate by owning the policy yourself. And so there are ways to use trusts, there are ways to use cross purchases, there are other ways to do this where you can actually take tax certainty on your IRA, spend some taxes or before you start your Social Security and other income streams, replace it with life insurance and leave that money to children and grandchildren tax-free, and whatever's left in income tax-free, and whatever's left in your IRA, you could then feel comfortable leaving to charity so that you're not taking that hit. This was a wordy thing, but basically leaving certain kinds of accounts behind is no longer favorable. IRAs are bad, HSAs are worse. Because the health savings account, people will grow it and they'll use it. And HSA is the greatest thing since sliced bread while you're alive or while you're married. But if you die, 100% of that is taxable to your heirs the year you die, and that can affect their tax bracket. If you live to be 92 and you're leaving your 70-year-old child money, you could be increasing your child's Medicare premiums by virtue of what you're leaving behind. So it's sort of a really interesting conundrum now. What do you see on this kind of front, and what kind of either trust planning or other structures are you using to help people mitigate this, not only for themselves, but for heirs?
It's funny, Eric, I mean, you just made the case for why people need to plan. I mean, it is so incredibly important because all the things you talked about, when people don't plan, I mean, the taxes can just crush somebody and crush a family, especially when you have an estate that doesn't have a lot of liquidity. When you have the bulk of your money in retirement, taxable retirement, and you have, in real estate, so it can really be a challenge. A lot of trust planning, see a lot of people with trust planning. A Maryland tax strategy is people who are open to it, is gifting, lifetime gifting. That's a great way to get the taxable base for Maryland down, whether it's outright gifting to children, gifting through helping, grandchildren with tuitions and maybe buying a house, gifting to a trust. You can gift to an irrevocable trust, and that removes things from your estate. And then kind of touching back on a combination, which is a estate planning strategy and also an income tax strategy that we didn't quite touch on, was that business owners, people who own businesses in Maryland, they are moving before they sell that business. I see it all the time. And that is where Maryland's really losing, revenue too, is if I own a business, I'm going to move to Florida where there's no income tax, and then I'm going to sell my business. And then because Florida doesn't have an income tax, I do not have to pay state income tax on the sale of that business. So couple that with the fact that there's no estate tax in the state of Florida, and you really make out ahead. So a lot of people they're planning based on residency. That's purely what they're doing. So between the trust planning, residency planning, gifting, I mean, they're really the strategies that I'm seeing. And then as you touched on, Eric, the charitable planning. So if you're somebody charitably inclined, you can really, make a big impact on a charity by utilizing those retirement funds to gift.
So there's a couple of things. First of all, we see in our own clientele that sometimes there's a hesitancy to do lifetime giving because there's a fear of needing the capital and the possibility of either an illness or some change in the economy or what have you, that you might need it. So unless you are wealthy enough that you can't possibly spend it, people are hesitant to do that. Now, I would say it's more fun to watch your kids enjoy the money than to know that they're getting it when you're gone. So there's a pro and con to that, and that's more psychology than finance, I guess. But we talk about residencies. There's been talk in the Maryland legislature about changing the 6 month and a day requirement, where if you have a home in another state and you're there for 6 months and a day, you are now a resident of that state and not subject to Maryland tax. And they're trying to change that to 3 months instead of 6. That's major because that means snowbirding no longer is an option for folks who want to do that, at least not from a tax shifting standpoint. We're also seeing the state of California, which if there's going to be bad tax policy, it's going to generate there. It's like they grow it. If it's going to happen, California is trying to find a way to tax people for anything that they owned, that they grew, even if they leave. So they're looking to try and reach into another state and say, hey, wait a minute, you earned that as a California resident, therefore you owe it here. And I don't want to give our legislature any ideas. I think you already did by saying we're going to move before we sell. I assure you, when I sell BFG, I will not be a Maryland resident at the time. It's foolish. It's foolish. And so you really can't stay if you want. And if you get to a point like that, we've had clients leave New York and go to Las Vegas. And what they save in taxes buys them a beautiful home. It's like getting a free house. We've had people move to Boca and they enjoy their savings so much that they buy two. Like it's obscene. And so if we don't get this right, if Maryland doesn't get this right, it means giving a break somehow to seniors on taxation, keep seniors here because seniors spend money on not only healthcare, of course, but education, entertainment, family, they shop. And we need to keep these people here. We need to keep businesses here. We need to make it more affordable. And I don't know what the tea leaves show, but right now, Maryland is looking not so good. The federal government, on the other hand, from a tax policy standpoint, one thing that we have to talk about is the Tax Cuts and Jobs Act. Because Tax Cuts and Jobs Act came in 2017, And it is supposed to, I believe, sunset at the end of 2025 if it's not extended. And I think it's likely to be extended. I don't know. Do you
I
feel
would
the same
agree.
way?
I agree
All right.
100%. I think it will.
Politically, it's likely to be extended. But what this does is it disproportionately hurts residents in states with high income taxes. And it was done on purpose. I mean, at the end of the day, taxation is weaponization of government. Both parties do it. So this is not a political statement, it's a reality. But the Tax Cuts and Jobs Act, which caps your SALT, it caps your state and local taxes that you can deduct against federal. The rationale being that if you were paying a lot more in state taxes, it meant you were paying less federal income tax, even as the same income level as somebody in a low tax state. And so the federal government said, well, wait a minute. Why is a person in California paying less federal tax than a person in Wyoming, even though they have the same income? And so they capped it at $10,000, which, as you know, is a nothing number.
Yep.
And so it means most people are not deducting real estate taxes fully. They're not deducting their state income taxes or their local, which is mostly real estate. And then we also saw the standard deduction go up so much that 90% of Americans don't itemize, which means people don't know it, but they're not even taking charitable deductions for the donations they're giving. If you give $500 to your school or your church or whatever, you're not deducting that if you don't itemize. And so philanthropy is changing, and it's changing through the use of donor advised funds and other strategies where you can pool some of your gifting for tax reasons. And if you're charitably inclined, and I know you represent lots of families that are charitably inclined, we do too. There are strategies around that too. You have to plan for that too. Don't just write a check. There are so many better ways to give to charity, and charities are just as happy to have that.
Yep.
So that's another piece. So in terms of other income planning, any other income tax planning that we didn't touch on? I mean, these are certainly some of them.
Yeah, no, I think you've touched on, a lot of the planning strategies. I mean, I think charitable planning is a huge income tax strategy. Income tax, estate tax, I mean, for somebody charitably inclined, it can have a very big impact. And I think it's often not talked about. And you're right. A lot of people are very afraid to part with their money, especially during their lifetime, because they're concerned that they're not going to have enough. So
There's just so many creative ways to do it.
there are.
If you have a home and either you don't have children or you have children who don't want your home, there are things you can do to utilize your home for your own benefit, a la reverse mortgages or other ways to tap your equity, or for the benefit of a charity while you're still living in it. There's so many creative things that can be done. And what I think financial advisors, accountants, and attorneys are guilty of sometimes is talking about tools and strategies instead of whys. At the end of the day, if you can dream it up and it's legal, there's a way to do it. Your advisory team will figure it out. What is the best way to accomplish what you want to accomplish? And so I think if there's a lesson in this, it's that you don't have to know all the tools. You don't have to know the difference between a charitable remainder trust, a donor advised fund, and a ham sandwich. It doesn't matter. You just need to know that these things exist and that you can figure them out.
Yeah.
Anna, let's swap slides and talk about some things that might be on the radar. Oh, actually, before we get there, you want to talk a little bit about the numbers? We sort of went here.
Yeah, sure.
You want to talk about it?
Yeah, I'll just do a recap here. From the federal estate tax exemption, as I said, it's about 14 million per person. Combined, they have a thing that, called coupling. So, if the first spouse to pass doesn't use up their full exemption amount, because maybe say that the first spouse to die left the survivor a nice life insurance policy or something that would be included in the second to die's estate, you can pool the two amounts together and utilize what's not used on the first spouse to die. So that's called coupling. As I mentioned, it could go back to about 7 million per person in 2026 when that sunsets. But as Eric and I both pointed out, in terms of the political climate at the federal level, it's likely that it will stay relatively stable about where it is, and it will be extended. Same thing from a Maryland standpoint. If it's 5 million per person, the federal was indexed for inflation. Maryland is fixed at 5 million. It does have that coupling where if you can combine it for a married couple. We'll see what happens if it does go to that 2 million. And then just to point out that estate tax rate at the Maryland level can range between 0.8% to 16%. So that number can get really high at 16%, especially when you're adding that to federal estate tax. If somebody is, I would say, so blessed to be subject to those taxes, it means that you have accumulated some wealth. It's a good problem to have and a bad problem to have all at the same time. And then just pointed out on this slide that there are other states on the East Coast that do not have this estate death tax. We are surrounded by states that don't. Delaware, Virginia, North Carolina, South Carolina, Georgia, Florida. I have clients in mass exodus going to all these places, buying their vacation homes, ultimately with the plan to move to these states, and that will be their final place to live. So that puts Maryland in a very interesting spot because we are surrounded by states that have very favorable, whether it's estate tax, income tax. So, from a business standpoint, people just go over the line. It's very close. We're not in these huge states. It's not like we're in the middle of Colorado where it's very hard to, look for services one way or the other. That's very interesting for us. And then inheritance tax. There's only 6 states that impose an inheritance tax, and we happen to be one of them, and we happen to be one state that imposes both the inheritance and the estate tax. Maryland is a heavy tax state. I mean, I think that's what this slide really points out.
All right, let's move to the next slide because there's some more taxes being considered, and there's some other things in the budget, in Westmore's budget, things like I believe there's a large tax plan on cannabis and some other things, some sort of one-off stuff. They're trying to close some gaps, but 2 taxes to at least have on our radar. One of them, the VAT, is a federal issue, and then the wealth tax is squarely at the state level, and I think terrifying, actually. So I'll take the VAT, and you can take the wealth tax because I'm too afraid to talk about it, if that's all right with you. The VAT is a value-added tax that is code for sales tax. That is a federal sales tax that becomes consumption-based, that some people love because it's based on what you spend, and some people hate because it's considered regressive. And so there's a political hot potato being played here, but it is real possible that at some point during our lifetimes, we will see a VAT tax applied so that every time you shop, now you see some cities have done this. Ocean City's done this. Philadelphia's done this. You see it certain places where you'll have the state sales tax and then the local sales tax. We could also be seeing a federal sales tax for these things, whether it's just goods or whether it's services or whether it's various things. So I think that's something to keep in mind. It is not likely to happen, I don't think, in the next year or two, but I do think there'll come a day where the federal government says we need more revenue, and this is going to be one place to get it. And now I'm going to let you handle the next one. I just can't.
Well,
I just can't do it.
Well, I'm just going to touch on the VAT tax because I am a very passionate believer in the VAT tax. I mean, that's how Europe does it. They have the VAT. The VAT, for a large part, a true VAT tax at the federal level is a substitution for a federal income tax. With exemption, normally there's exemption on food and, the things that we need in life to survive is normally exempt. I believe a VAT tax captures illegal money. That's the beauty of a VAT tax. If somebody is, obtaining money illegally, whether let's just use drug sales or, criminal activity, if they want to buy a TV, we're going to collect taxes on that. So it really captures that money. So my 2 cents on a VAT tax, I think it's
I tend to agree with you, although this is it's too early in the morning for that. We need bourbon, not coffee. Let's talk about the next one. Yeah.
So the wealth tax. I mean, that's basically a proposed tax on people who, make higher incomes. It's this philosophy that the more you make, you should pay a bigger share. You should pay extra and more. And when we say a wealth tax, wealth is being relative. this wealth tax could be on somebody that, earns $500,000 or more. It doesn't mean that you're somebody that's making, $5 million a year. So, I mean, that different
Well,
administrations have different opinions on this
yeah.
wealth tax and what is
Yeah.
wealth.
Well,
Um,
and I think what you're referring to, I think, is the surcharge on the millionaire tax that Maryland has suggested, which
yes,
says that you'll have an additional. It's kind of like the surcharge on Medicare. When you make
yes.
enough money, your Medicare premiums jump. I don't mean when you're receiving Medicare at 65. I mean when you're paying payroll taxes, your payroll taxes
Yep.
jump over a certain limit. I'm talking about the wealth tax, which would be the tax on actual property owned. This idea that you'd have to do annual appraisals and pay a tax of up to
Got it.
1% for the
Yep.
privilege of having property.
Okay.
This to me is terrifying. The surcharge on millionaires is coming. It's such
Yeah.
low hanging fruit. People will vote for that because most people don't pay it. So they'll vote to take it from somebody else. But the wealth tax is different. The wealth tax would require everyone to appraise their entire net worth on an annual basis and to give a fraction, whatever it is, 1% of that number to a state or municipality. So if, let's say your net worth is in fact $10 million between all of your various things, your real estate, your farm, your business, your retirement plan, et cetera, you could have an extra $100,000 of taxes just because you're worth $10 million in addition to all the income taxes and the other things. That terrifies me for lots of reasons. One,
Huge burden.
it feels like abundant theft. But two, it's expensive to appraise things.
Mhm.
We already spend significant money doing tax filing, paying a CPA, paying for tax advice, paying for that, which I would not do my own taxes. I joke sometimes I'd rather give myself a root canal than do my own taxes because it is an unbelievable process. But the wealth tax would require business appraisals, real estate appraisals, jewelry appraisals, appraisals of closely held assets that aren't readily marketable. And then do you apply a marketability discount or a minority discount? Or and you'd have to almost do a full audit of your wealth every year just to determine what you're worth so that you can pay taxes on it, only to then have the IRS or some other agency involved say, we think this is valued unfairly, and so we're going to tax something on. And that scares me to death because that creates a burden for taxpayers that is extreme waste of time and an extreme way to say you're not allowed to have property anymore.
And I think likely the chance of that type of tax happening, especially in the current administration where it's shrinkage of government, not growth of government, because this would require a huge undertaking from like you said, the IRS or a new agency to be able
Yeah.
to monitor that type of tax. I mean, that would be.
Yeah, I don't see it federally. I see Maryland being the first state to try it.
Right.
I
Again,
do. I see the comptroller's office saying this is a great way to raise revenue. I see it in the tea leaves, and it scares me to death because it's literally absconding with other people's property in an arbitrary way.
and I think again that would even exacerbate the exodus of people from Maryland. I mean, that would be a sure way. I think we'd see people leaving in droves.
So let's end on a good note. We'll let Hannah, if you have any questions, put them in the chat box. Couple things. First, we have a free resource. If you use your camera on your phone, go ahead and take a snap of this. This is Pay Less Taxes Now. I wrote about 18 months ago. I'm actually going to do a new edition soon, but it's still, from a strategy standpoint, there are 4 places that most American taxpayers can put money where it's never taxed again during your lifetime if you use it properly. This is free, so grab a copy. And in 1 second, we'll switch the slide because I know Nicole's going to do something similar. All right, Hannah, you want to talk about this?
Absolutely. So this is my tax planning, estate planning workbook. I always like to say that planning is more than just the documents. It's about thoughtful planning. It's about conveying to your family what matters most to you. And so this is a workbook that if you scan the QR code, visit our website, you can download for free. That just helps you getting your legacy and your planning down on paper in a thoughtful way.
Perfect. And the last slide, which is our mugshots, but also our contact information. I know Nicole would be delighted to hear from any of you if you have questions about your estate plan, income taxes, or anything else, and I would certainly be the same. Hannah, anything in the chat box? Any additional questions or last minute items?
Yeah, so I have a question here. If you're unhappy with the prospect of a wealth tax, what are some things you can do to be proactive about your opinion?
I mean, first of all, work with your legislators, be active. You know, I grew up in a house where my parents didn't do that kind of thing, and I've now learned that you must be there. You must be there physically. You must testify. I have testified before the state Senate, for example, in favor of financial literacy education in schools. There are things that just make sense, that matter, and your voice counts if you use it. And so I think whether it's at the state level, the federal level, at your county or jurisdiction, you must make your voice heard. It's okay to have dissenting opinions. To find 100 people who agree on everything is foolhardy. It's okay to have healthy debate and discussion. And I just encourage you to be part of the discussion and not to, put your head in the sand, because if you do, you're going to be subject to whatever comes out of it. Nicole, I don't know if you want to add to that.
No, I agree 100%. Right to your local representative from a state standpoint. Get involved, get on their distribution list so you know what your local representative is proposing or where they stand, and let your voice be heard. It's very important.
Yeah, I think numbers talk. When if you're in Annapolis, almost every night there's a group supporting something or protesting something, but there's groups there almost every night at the Capitol, and I actually think it probably matters how much noise is being made. It's all assuming it's appropriate, and it generally is. How many people show up? How many people sign those petitions? How many people make their voice heard? And how much sharing you're doing on social media, because the word spreads so fast today. If there's something you're excited about or something you're concerned about, share it. I mean, you will upset some people sometimes, but at the end of the day, if there's an issue, if the Connolly case is something that you're passionate about, share that. Make sure people know what it is, because a lot of people don't, for example. Anything else, Hannah?
I think there's so much focus on the federal level right now that people sometimes don't realize what's going on at the state level. So I think really, focus on the state. Take a look at what's going on, whether you're in Maryland or another state, and be just as engaged and in touch at the state level as you are on the federal.
Well, yeah, it's much easier to go to Annapolis and have your voice heard than to go to DC. It's such a huge thing. And so that's why you join organizations and you support those organizations, that whether it's charitable and it's a cause important to you, or whether it's a business group, or whether it's a political group, or whatever type, whatever you believe in, supporting that matters, and having strength in numbers is a big deal, no matter what you support. So I think it's great when people are active and involved. We got about a minute left before we leave the air. Any last questions?
One more quick question.
Great.
This one's a common one. What are any tax benefits for first-time home buyers that they should look out for?
You want to talk about the first-time home buyer credits?
Sure, absolutely. So from a first-time home buyer, you can get a credit on your transfer taxes. State transfer taxes, if you're a first-time home buyer, it requires, if a husband and wife are buying, both must be a first-time home buyer. You get an exemption from having to pay those taxes. From a lending side of things, there are some programs for first-time home buyers to help you with your loan. But those are the big areas for purchases.
Yep, I think that's dead on. I have nothing to add to that. Well, thank you all for being here. We had a nice crowd today and some good questions. This program will be available. All of you who registered will get a copy sent to you, so you can view it again if you'd like, or share it any way you'd like to. Nicole and I would absolutely love to hear from you if there's either comments or questions, or the opportunity to look at your planning. We'd love it. And I would just like to thank everybody for being here. Nicole, thank you. You make this really easy. You're wonderful to work with.
Thanks for having me.
Take care, everyone. Have a great day.
Bye-bye.